Welcome to the Trader Hotline, sir.
Hey Desi, how you doing?
Good, man. What's going on?
Nothing. Well, first I want to say with everybody listening that I follow you every morning. I'm a part of your Monday, Tuesday, Thursday, Friday, and just watching the trades, following along. I use your levels every morning. I look it up. I'm up at 6 a.m.
Nice, man.
Just working on this stuff
Yeah, put in
so
the
that
work.
I can be exactly so that I can be prepared to not only follow along but also work my own trades and follow some of yours.
Yep.
And it's an amazing service. It's 100% paid for itself, totally worth it.
Appreciate that, Seth.
So
Thank you.
absolutely, you're awesome. So the question I have is, I'm trading a medium account,
Okay.
and what I'm getting into a trade.
hmm
I'm sizing up. I'm using contracts, say 10 contracts. So I'm not looking at how much those are worth. I'm just sizing it like 10 contracts,
hmm
and I'm trying to look for where I'm scaling. So, I watch you in the morning and I watch, you usually, exit out of a certain percentage of what you've currently got in play. And
hmm
then the second tier, you'll exit out of, another
Yep.
tranche.
Yep.
And then you'll leave a couple of runners. And that's
hmm
where I'm kind of looking for the strategy is how to scale out and maybe even at some point scale back in. But how do
Yep.
you scale out to a point where you're just leaving runners?
Got it. So first off, Seth, thanks for calling and thanks for those nice words about what we do. Second, uh, I want you to make sure you're paying attention to what the contract values are. So when you're buying 10 contracts, I need you to pay attention to what that's actually worth. Because I mean, I think in extreme examples, then I think you probably do look at them like you're not going to trade a $10 contract the same that you're going to trade a $2 contract. So as long as you can say that,
100%.
okay.
Yeah.
So we have that. I'm just making sure I have that ground covered because there's a big difference between that. But anyways,
Yeah, I'm
let's say
definitely
that.
not trading
Yeah.
$20 contracts at 10,
Right. Right.
10, 10 bucks.
Yeah. So let's just say you buy 10 and you're comfortable with the equity position. So, what I like to do, Seth, here's what I like to do, okay? And I can very easily talk through my strategy because, once again, it's something that I try to follow every day. I like to front load my risk. And so I like to put my full size that I'm willing to take in the beginning of the trade. Now the reason I do this is because where I'm taking a position is where I think that it should start to work. And if it doesn't start to work at that particular point, then I no longer believe that the trade is valid, right? That's just theoretically and through my mind and just sort of mentally how I think about it. So if I'm about to take a position, then I better be taking a position at where I think it better start working right away, or at least very close to this area within some kind of a margin, which is, let's say, my stop loss, right? Let's say it's a dollar below or a previous day low or whatever it might be. Hey, I like it to start moving off this level. If it does, then this is what I want my trade to be. If it doesn't and it breaks below this spot, then that's where I take my loss, right? But if I'm going to be looking to take a trade and the reason and I'm happy to take risk at that point, then why not put the total amount of your position that you're willing to take at that point right there? Because at that point, if your mind is saying, hey, I like this trade here to go higher, then we should be taking, in my opinion, the most risk that we're willing to take at that point because it's the lowest amount of risk. If it goes higher from that point and we put more size on, then we're adding risk, right? If we're going to take a position at X and it goes up to Y, our stop loss is still under X. And so if we're adding higher and we're adding to a position higher, I still want my stop loss to be down back there, right? Down at that original spot. So I like to front load my risk. Now, the reason and how this helps me with scaling out is if I'm front loading my risk at that key inflection point, by the time, let's say, someone is adding to their position when it's maybe up 20%, let's say the option premium's up 20%, I'm taking half off. And so here's my mentality for doing this. Now, this has been a very, I've had a lot of questions about doing this, and here's my reasoning, okay? Getting half off at 20% may limit my upside potential because I'm taking a pretty large portion of my position off up that, let's say 20% is roughly where I'll take that first tranche, as you probably have seen me do pretty robotically when you watch me trade live. If I'm up that 15, 20%, bam, half off every single time. this caps my upside, it limits my upside, but it also greatly limits my risk, right? So we all know as traders that the market loves to reverse out of nowhere, just random reversals, especially in the market that we've seen lately. And so if I can grab that 20%, it's much higher of a percent chance for a contract to run to 20% than, let's say, to 100%, right? If you could run that statistic over the last, let's say, 5 years, what's the percent chance that this contract goes at least 20% higher versus 100% higher in a particular day? I would say 20%, 20%, moves on an intraday are much more likely than it to continue and run to that, big 100% move. So if I can catch that 20% move with with my full size, I want to take some risk off there, because once I take that risk off of 20%, if it does reverse on me, then I only have half of my equity in that position left. What this does for me is it allows me to relax, because I know, okay, I've gotten 20% off, or I've gotten half size off of 20%. If this does reverse on me from this point, I have less money in this trade, and I have realized profit in my pocket. And if it does reverse, let's say it goes back to break even, and I cut the rest off break even, then I've netted that 20% gain, right? Or let's say it goes to my stop loss, then it's probably padding that loss quite a bit, right? Because I've realized, let's say, $500, and then on the remaining of position, I lost $600. So net, I've lost $100, where maybe I would have lost $800, right? So I got 20%. That's all it went. It reversed on me. Why not take that win, right? Why not limit our downside risk? So taking that half off of 20%, it limits my upside, but it also greatly limits my downside, which I love. And for me as a trader, I would 100% every single day of the week limit my upside, and I would 100% any day of the week limit my downside risk, right? I'd rather be someone that is making less but never losing large, because that, in my opinion, is sustainable, right? If I can make less than the next guy, but when I lose, it's always less than that guy, that to me is the person that I want to be as a trader, right? That's the mentality that I want to continue to trade with. So that's sort of the mindset behind it, right? Now, from that point, it becomes a little bit discretionary, okay? From that point, Seth, I'm either targeting a next level, right? So while I'm in the trade, I'm looking at the chart. I'm looking at, okay, I got this next high. Maybe we broke above Tuesday's highs, but then I got Monday's highs about a point higher, right, Seth? So that would then be my next target. So I'd say, all right, I got half off up my 20%. I'm going to now target Tuesday's highs, which is maybe a point and a half higher. If I get to that point, I'll take another half off, right? And then if I get higher, I'll take another half off, right? And I'm sort of using key levels on the intraday, but also a little bit of discretion, right? Now, where does that little bit of discretion come from? Well, let's say we're moving higher and the NASDAQ starts to fail a very key supply level, right? I'm long Tesla, NASDAQ's up into key supply, NASDAQ starts to reject. Maybe you say, hey, I don't like that NASDAQ rejection. Let me take this trade off, because if that NASDAQ starts to fail, Tesla's going to fail as well. Now, that doesn't always happen, but that's a larger majority of the time. So after that first initial scale out, which is always automatic, right? That part of the system, always automatic. Get that first 20% in the pocket, take that win, limit your downside risk. Then let's see if we can run this thing. And then we're sort of using some discretion in terms of key levels and price action to then run that out. The 9 EMA, the EMA Cloud is a great tool. VWAP's a great tool in a trending market, right? Just looking at where those realistic next targets would be based on the chart. How's that?
Got it. That's great. So it sounds to me like first key level is 20%, scale out 50%, and then every key level above that, you're scaling out 50% of the position you've got left.
Pretty much, yeah. So if I'm going from 10, then I'm going to 5, then let's say I'm going to, so I'd probably from 10 to 5, I'd go down to 3, so I'd take 2 off next, then I'd take 1 off, right? And then I would just try to get to like 1 or 2 contracts and see if I can just forget about them and see if they can keep running. At that point, it's money in the bank. If it fails with 2 contracts from 10, you're not going to lose. It's impossible I mean, you'd have to, even if it went to zero, you'd still be green. So you're sort of sitting in, you're just sitting in, you're playing with the bank's money at that point. You're playing with the house money. So I like to be in that position. That's the position I love to be in. I got house money. I've locked in more than what I have left in this position. I have 2 contracts worth $500. I have realized gains of $1,500. So if this thing goes to zero, which it's not, I literally cannot lose anymore. And let's see what this can do, right? That's what I like to do. I think a few things before you go, Seth. Number one, always have targets in terms of the key levels, okay? Like, we always look at the key levels. Make sure you know where you're targeting. But at least if you get that initial push in your favor, take something off the top, reduce your risk, and then see if you can reach those targets. And the reason I do that, like I said, I'd rather be a small loser and a small winner than a big winner and a big loser. That's just how I think I think that's the right way. I think that's a sustainable way. So hopefully that answered your question tonight, Seth.
Yeah, that was great. Thanks, Desi.
All right, man. Have a great night.